So, hi everybody. Welcome to another edition of Stock Talk. My name is Aman. I'm an investment coach here at Sage Investors. And as I said, this is episode 27. And today is kind of a little bit building off of the previous episode where I was talking about some of the investing strategies of the moment. And one of the big ones I was talking about in the last episode was involving low volatility ETFs, which seem to be flying off the store shelves in the whole finance community right now. It's interesting though when you look at the whole ETF thing. If you look at it, ETFs are kind of the investing vehicle of the moment right now. Just looking at the big sudden shift outflows from traditional mutual funds into ETFs. I was just reading a report talking about in the last month. Out of $39 billion of money shifted out of traditional investment vehicles into ETF products. And out of those 39 million, 27 billion, I'm saying with a B, 27 billion, this is the US, so I'm focusing on, 27 billion basically went into two companies, Vanguard and Schwab's family of ETFs. And the big reason is cost, and right now there's a huge price war going on right now in terms of ETF providers cutting their MERs or management expense ratios down to practically nothing. Like Vanguard and Schwab are like charging like 0.05%, 5 basis points for their vanilla products is practically giving it away. So the competition is getting extremely rough, and when things get crazy like that, often other companies that are looking to get into the game are going to try and differentiate themselves. And in the finance game, it's all about cranking out product. And in the last little while, we're seeing quite a bit of proliferation of different kinds of ETF products that are kind of like stretching it from the traditional passive investing type formula, which is the whole premise, the business model, the value proposition of ETFs is that whole passive investing is a much more effective way to generate returns than actively managed investing. So what we're seeing right now is such a proliferation of different type of products. I just give you a few that are out there. There was one that just came out by a fund company touting millennials. Just targeting millennials and investing in companies, and basically a basket of companies that are going to cater to millennials. There's a product by another company that's focused on short-term corporate high-yield bonds. You're seeing funds, ETF products coming out talking about investing in baskets of Silicon Valley type companies, companies focused in IT security, social media. There's all these different kinds of flavors of the month kind of products that are out there right now, and it's, again, as part of it is just trying to get some extra yield or just extra basis points on their products because they're losing money to these generic passive kind of ETFs. So on top of that, these type of products, when you're looking at it from an investor perspective, are much more complex to understand. They're not just your run-of-the-mill investing in the S&P 500. There's a lot more complexity in how these products are structured. And for the average investor, you're just not going to know that unless you lift the hood and take a look and do some serious due diligence, which is not easy to do. Frankly, I'd rather analyze an individual stock than some of these ETFs, because you just need kind of like a math degree or a statistics degree to understand what the heck they're doing in these products. It's easier for me to go and analyze Disney, it's a big stock today. I know what's going on, I know what's behind the company, I know what the people are doing, what the strategy is. When I'm analyzing an ETF that's catering to millennials, I have no idea what the justification and the basis and the rationale of it is doing that. So right now, and from what I've been reading, there's a really interesting article talking about this, all this differentiation in ETF products. Basically what these ETF providers are doing is they're just cranking out product on anything and just launching darts, throwing things at the wall and hoping it's going to stick. And basically whatever sticks is going to be, they're going to, push it and milk it for everything they can get. So, if there was a, Game of Thrones kind of ETF coming up, it wouldn't surprise me. It's just the nature of the financial services industry. Again, it's not talking about helping people, reach their financial goals. No, folks, it's about pushing product. It's about market share. It's about assets under management. And so what scares me is we're going to see more of this. We're going to see a lot more of this, and we're going to see a lot more intense marketing of these type products. And what concerns me is for the average investor out there who's just trying to do the right thing, they're not going to get it, and they're not going to see it. And I think there's going to be a lot of sad stories coming out there as a result of this, a lot of this proliferation of, these extreme kind of ETF products that are really skewing away from their whole business model, traditional value proposition. So it's a dangerous time, and I just like saying, if you're going to go down the road and take look at some of these type of products, go do your due diligence and understand what you're getting into, understand what you're paying, because chances are that the expenses, the costs of commissions are going to be a lot higher than your generic vanilla ETFs. And why is this happening? Well, it's because it's about marketing, it's about pushing product, and it's really about tapping into one of our core behaviors that we have, each and every one of us, and the one I talk to when I work with people is it's just about following the trends, following the flavor of the month, chasing performance. Why do we do that? Because that's where we're wired. We want to be associated with kind of the hip, the cool, the happening kind of pop culture kind of tidbits that are out there. And from an investing perspective, the financial companies know this, and will try to, tap into that kind of behavior that we have, and that kind of yearning, that kind of need that we want to have is to be associated with these type of, be associated with the in crowd. Kind of gives us that security level. So it's just that when I'm seeing more and more of these type of products coming out there, it's just, I become more concerned that people aren't just going to get it, and they're going to make some really bad investment decisions that are going to hurt them in the long run. So really look out. If anything I can tell you is just when you see these kind of flavor of the month kind of products coming out there, look the other way. They're not the ones that are going to get you to the goals that you need to get to. So that's all I got for you today. And if you have any questions, or you want to drop me a line about talking about some other kind of investing concept you want me to talk about, give me a shout. I'm at through my website, www.sageinvestors.ca, or you can hit me through Twitter. My handle is @SageInvestors. So I'm on there all the time, commenting, observing various elements of the market, the behaviors of people and investors, and investment decisions that I'm making. So that's all I got for you. That's another edition of Stock Talk. My name is Aman of Sage Investors, and we'll catch you again another time. Take care.